Let's talk market fundamentals with K. Ramanathan, Chief Investment Officer with ING Investment Management. Ram, good afternoon to you and thank you for joining us. Nothing is happening. 2014 everyone thought would be the year of mid-cap, but mid-cap stocks are not doing anything. Nifty is stuck in a range, and globally also the triggers are missing.
Yeah, I see a range-bound market at least in the near term. Surely the upside is capped because of the pace of recovery, which is expected to be pretty slow. There is consensus that the market as well as the economy has bottomed out, but clearly you need more things on the ground in terms of action on infrastructure, power, etc., which needs to be given a fillip for the market to go up. Surely the current political issues which resulted in cut in tariffs is a retrograde step that is not being positively accepted by the market, and the worry in the market is will there be more populism before the elections? And clearly with the emergence of AAP, the comfort which the market had in terms of NDA government coming into the picture is also subdued a little bit. So clearly there are uncertainties which is preventing the market to go up. From a downside perspective, at least there are several sectors from the results which have been released so far which have done extremely well. The outlook is pretty good. The IT sector, the private banking space, despite so many things being talked about, CDR referrals and so on and so forth, is in the pink of health. Loan growth is a problem, but at least incremental slippages are pretty low. Also, the pharma space, except for a couple of names which are down under because of certain problems with manufacturing facilities, most of the other pharma stocks have also done well. The outlook is also pretty robust. So this segment of the market is holding on the index. If you see the second segment, which is industrials and financials, they are at very attractive valuation. So the scope for significant fall in these stocks, given the attractive valuation, is also low. So in the near term, I see a range-bound kind of a market.
Ram, what is it that you're expecting from the RBI policy next week? And does it seem like this could be a game changer for the markets, or is it something which is already in the price?
See, we need to wait and watch. Surely the Urjit Patel committee report is not positive for the markets. The anchor is going to be CPI combined inflation, not even core inflation, which historically has remained quite high. And this inflation is more driven by the government policies rather than by demand. Because if you see a significant component is food inflation, MSPs have been increased because of political reason consistently. While the lowest MSP increase has been in the range of 5 to 7%, we have seen 35 to 40% increase also during certain years in 2006 to 2008 period. So if food inflation is going to be a bare minimum of 6 to 7% and fuel inflation is yet to pass through, surely the near-term outlook on the CPI in terms of it sharply coming down is not going to be there. So the big question now is, will the RBI bite the bullet in terms of focusing more on savers to give them positive real interest rates anchored to the retail inflation, ignoring growth? That is something which all the economists are debating now, and hopefully the policy on 28 should give us some roadmap in terms of the governor speaking out his mind. In terms of expectations in the policy, it's going to be, I had an expectation earlier that there won't be a rate hike, but given the Urjit Patel committee recommendation, if that is expected to be accepted, then possibly one can pencil in a 25 basis point rate hike. But I would say I'm 50-50 on that.
Right. Let's look at the auto index, and the auto index today also in line with other market also has cracked by about 1% plus. So today the selling is largely concentrated or largely led by rate sensitives and especially economy related sectors. Ram, even though the auto dispatch numbers have not been strong, the SIAM outlook for 2014 is nothing short of scary. Autos as a group have done rather well. Why is that?
Actually, we are underweight the auto sector, so we are not positive. We are also puzzled by the movement in some of the stocks, not all. So we are underweight the two-wheeler segment, mainly because of the fact that the valuations of some of the large cap stocks are 14-15 types, and we are not seeing any significant resurgence in terms of demand in this segment. So possibly there could be earnings downgrades down the line, because of which we are underweight. In the four-wheeler space, we are overweight. So while we are underweight the auto sector per se, we are overweight the four-wheeler space.
What about pharma? Because on one hand, when there are names like Ranbaxy which have been plummeting, and of course news as well, backing the move, but on the other there are names like a Sun Pharma, Dr. Reddy's, Cipla, or even smaller ones like an Aurobindo and Biocon which have been doing well of late.
Yeah, we are overweight the pharma sector. Clearly, you need to stick to the well-known names who have a decent track record. Some of the names which you have mentioned have had problems in the past. It's not the first time these companies are having problems in terms of manufacturing facilities. Some of the manufacturing facilities earlier also have been down under in terms of import alert from the US FDA. So I would say stick to the well-known names where you don't have, you've not had such issues in the past. But clearly, given the feedback from the management that the pipeline in terms of the molecules which are going out of patent and the revival in the US, these two are key reasons why we feel that pharma sector will continue to do well.
Appreciate your time and thank you for joining us.